The concept that I am about to discuss is an important concept when it comes to non-current assets, inventory, or any other discussion in financial reporting. And that concept is refundable taxes. But before we get into a discussion of refundable taxes, let us understand what are indirect taxes. Okay, so there are two types of taxes, direct and indirect. And what is the defining feature of indirect taxes? The thing is, the impact and incidence is not on the same person. And what are some of the examples of indirect taxes? There is GST, there is VAT, there is sales tax. You had a tax called excise duty. Then you have entertainment tax, and you also have customs also as a part of this. Now, let's understand what is the idea of indirect taxes. The government wants to tax certain commercial transactions, like the transaction of sale, the transaction of expenditures, transaction of purchases, so on and so forth. So what the government does is the government levies a tax on the transaction of sale, which is called sales tax in most countries. Now, the way sales tax works is, if I am selling you something worth 100, on that I have to collect tax from you at a predetermined rate. Say that rate is 20%. So the price of that item for you becomes 120. So let's imagine a situation where Satyamed sells goods to Rutva, and Satyamed sells goods to Rutva on credit. Okay. So on Satyamed sells goods to Rutva on credit. The base value of the items sold is 40,000, and the government is levying a 10% sales tax on such transactions. Okay, the government levies 10% sales tax on such transactions. What happens here is, when I sell goods to Rutva, I have I will collect 40,000 from him, but on the transaction of sale, the government is going to charge 10% tax. So what is my accounting entry in this case? By customer account debit. So by Rutva account debit to sales account. See, the value of goods sold is 40,000, and to sales tax payable account. Okay. Rutva account debit to sales tax. Sales tax is 10%. And what is the amount recoverable from the customer? The amount recoverable from the customer is 44,000. Now, Rutva sells these goods to Janelle for 80,000, and he also collects tax at the rate of 10% on the transaction of sale. Now look at the situation. Let's record the entry. And this was an entry in the books of Satyamed. This was entry in the books of Satyamed. This is entry in the books of Rutva, who is the purchaser, by the way, in this situation. What is the accounting entry that he records? He will record an entry by purchase account debit. Okay. By purchase account debit, by tax on purchase account debit to Satyamed account. By purchase account debit, by tax on purchase account debit to Satyamed account. 40,000, 4,000, and the total amount payable is 44,000. Everyone is with me till this point, I'm sure. Now, when Rutva sells goods to another person called Janel, what entry does he record? In the books of Rutva, the seller. In this transaction, Rutva is the seller. Okay. He is the seller now. So he will record an entry, customer account debit. So by general account debit to sales account to sales tax payable account, to sales account credit and to sales tax payable account. Okay. And to sales tax payable. This is for 80,000. This is for 8,000, 10% on that. And the total is 80 plus 8, that is 88. Now think about this transaction from Rutva's point of view. Okay, now we are assuming that he has to pay tax on sale and there is no other provision yet. Now, at the end of the month, he has to pay 8,000 to the government. And when he purchased goods from Satyamed, he was supposed to pay 44,000 to him. That 44,000 included an amount of 4,000, which was on account of tax on purchases. Okay, so understand here that when Rutva purchased goods from Satyamed, he was supposed to pay 44,000 to Satyamed, and this included 4,000 for sales tax. So for Rutva, there was an outflow of 4,000. Okay. When he sold goods, the base value was 80,000. On that, a tax of 8,000 was levied, and he has to pay tax to the government. Amount is 8,000. Okay. So there has been a situation of cash outflow twice. So for Rutva, there has been a cash outflow twice. 4,000 as a part of 44,000 payable to supplier and 8,000 as a part of 8,000 sales tax payable to the government. There has been a cash outflow twice on account of tax. Now think of it from Rutva's standpoint. He has to suffer tax twice. Once when he is paying the amount to his supplier, the tax amount is included. And again, when he is paying to the government, he has to pay tax twice. And imagine from a seller standpoint, this will be a big challenge. Why? Because on the same amount, he is paying tax twice over to the government. This is unfair for the seller. So naturally, all the businessmen in the country are going to revolt against such kind of a tax regime, which expects them to pay tax once, then again pay tax on the sale value 8,000. So for him, there has been a tax outflow or cash outflow of 12,000 only for taxes, naturally. And the seller will always say, why am I paying tax twice? I am paying tax once. There is a cash outflow happening when I am purchasing, and then there is another cash outflow happening when I am selling the goods. There is a cash outflow twice. And naturally, no business person is going to agree to such a situation. So, to remedy this problem of double taxation on the same amount, the government came up with the idea of input tax. Now, what is input tax? So, the tax paid at an earlier stage is allowed to be adjusted against tax payable on sale. Okay, this is the basic idea of input tax credit. So, the amount of tax payable will be tax on sale minus tax on purchases. So for Rutva, in this case, tax payable will be 8,000 tax on sale and 4,000 tax on purchases. Tax payable to the government will be 4,000. So now Rutva has anyway paid a total amount of 8,000, but 4,000 was paid here and the remaining 4,000 was paid here. Total cash outflow for him was 8,000. This facility which the government gives you in the indirect tax laws is known as input tax credit. Tax paid at an earlier stage is allowed to be adjusted against tax payable on sale. This concept is known as the concept of input tax credit. Okay, and those taxes which allow for input tax credit are known as refundable taxes. Those taxes which allow for adjustment of tax on purchases against tax on sale are called refundable taxes, because the tax paid at an earlier stage is getting subtracted, amount paid earlier is getting adjusted, is getting refunded. These taxes are known as refundable taxes. And this facility of input tax credit is available for which all taxes? It is available for value added tax. Value added tax is called sales tax in certain countries. It is there for GST. It is there for all of these taxes. So this is the basic idea of refundable taxes. Now, if I am purchasing a non-current asset, okay, say I am purchasing or I am buying a non-current asset, say I am buying a machine. I am buying a machine worth 10 lakhs and GST rate is 10%. The amount payable to supplier is 10 lakhs plus 10% of 10 lakhs, that is 11 lakhs. 1 lakh is tax paid on purchase. Now, this 1 lakh, that is tax paid on purchase, is allowed to be subtracted from the tax liability I will have on the sale of a particular item. So, during the year, I sold goods worth 80 lakhs. GST at the rate of 10% payable on such sale was 8 lakhs. Okay. Now, tax paid on purchase of any item. It could be goods, it could be capital assets, it could be expenses. Tax paid on purchase of any item is allowed as a deduction from the total sale, from the total tax liability. Okay, so your amount payable is 8 lakhs minus 1 lakh, that is 7 lakh. Okay, so you are getting a benefit for the tax paid on purchase in the form of adjustment from the final sales tax liability. These taxes are, again, I'm repeating, these taxes are called refundable taxes. Now, if you include the 1 lakh GST on purchase of machine into the price of machine, into the cost of machine in books of accounts, you will show the machine at 11 lakhs. Okay, you will show the machine at 11 lakhs and depreciation will then be calculated on 11 lakhs. Okay, on 11 lakhs. Say useful life is 5 years. So depreciation per annum is 11 lakhs upon 5 is 2.2 lakhs. Okay, so what is happening here? 11 lakhs upon 5 is 2.2 lakhs. 2.2 lakhs is getting credited to P&L. Sorry, getting debited to P&L. 2.2 lakhs is getting debited to P&L. Now, just pay attention, okay? Had you not capitalized the GST amount, the cost of asset would have been 10 lakhs and depreciation per annum would have been 2 lakhs. Now see what is happening when you capitalize the amount of input tax in the cost of the asset. When you capitalize the amount of input tax in the cost of the asset, the amount of depreciation increases and it again enters P&L and it reduces your taxable profit. The problem here is that you are taking the benefit twice. If you capitalize the GST in the cost of the asset, you are taking the benefit twice. Once in the form of input tax credit and second in the form of depreciation, which is reducing your profit and therefore also your tax liability. So the financial reporting principles are against this double benefit that you want to take. So what they have said is very clear that if it is a refundable tax, it will not get capitalized in the cost of the asset. Okay. When you claim input credit and also capitalize the tax amount in asset cost, then you claim benefit once by way of input tax credit and reducing by way of input tax credit, which reduces your out which reduces your GST payable. Second benefit is by way of increased depreciation, which reduces your profit and thereby your income tax. So if you keep it as input tax credit also and you capitalize it in the asset also, you are taking the benefit twice. So financial reporting principles disallow this double benefit. So what is the rule? If the tax is a refundable tax, only take input tax credit. Do not capitalize this amount in asset cost. Okay, are you all with me? You will have to go through this carefully to understand why are we not allowing you to capitalize the amount of GST, which is a refundable tax in the asset cost. And with that in mind, let's talk about non-refundable taxes. Okay, what are non-refundable taxes? These are taxes in whose case you cannot claim input tax credit. So tax on sale minus tax on purchase concept is not there. Those taxes are non-refundable taxes. What is the example? The example is customs duty. In case of customs duty, you do not have a situation which allows for you to subtract tax on purchase from tax on sale. That concept itself is not there. So custom duty is a non-refundable tax. And see, here you cannot claim input tax credit. So the only way you can make use of this is you will have to capitalize it in the asset cost. So this amount of any non-refundable tax paid is capitalized in asset cost. Now I want you to understand one thing. Why is customs duty capitalized in asset cost? This is in case of non-current asset. Also, Non-refundable taxes paid for inventory purchased are added to cost of inventory. Please understand one thing, that why are non-refundable taxes getting added to the cost of the item? If you remember, the concept that we had learned when we were doing non-current assets or inventory is any cost that is incurred to bring the asset to its current location and working condition has to be included in the cost of the asset. Now, when I am purchasing a machinery from a foreign location, see, unless I pay customs duty, that machinery will not be released from the government warehouse. So payment of customs duty is necessary to get the custody of my machinery. So the custom duty cost that I am paying is absolutely necessary to bring the asset to its current location and working condition. Hence it is capitalized. Otherwise, if it were taxes like GST and all of that, these taxes are refundable taxes. Those you don't capitalize, but non-refundable taxes are capitalized in the asset cost. They are also included in the inventory cost. This principle is was covered in your FA, FR. So we have already covered this principle in the past, but your knowledge of financial reporting will not be complete if you don't know how this works. Hence, I have included this as a separate discussion today. Do watch the entire lecture, and wherever you have a question, please ask me. Thank you so much.